Hello, and welcome to Macro Minutes. During each episode, we will be joined by RBC Capital Markets experts to provide high-conviction insights on the latest developments in financial markets and the global economy. Please listen to the end of this recording for important disclosures.
Welcome back to Macro Minutes, the European version. My name is Peter Schaffrik, and I shall be your host today. We're recording on the 8th of April, 2026. And frankly, we couldn't have picked a worse time. We're just recording a few hours after the ceasefire agreement that might or might not hold. The market is very volatile once more. Pretty much every asset class, for a change, is performing very, very strongly. And it would be quite difficult and challenging to record in the here and now and make a very clear and decisive interpretation of what is going on. Fortunately, however, when we were planning for this edition, we had a different setup in mind anyway. One of the other topics that has vexed markets for quite some time is private credit. And fortunately today, I'm joined by one of my colleagues who knows pretty much all about it. Marc Sanchez. He is sitting on our credit strategy desk on the same floor as me here in London, and he has just recently released a very interesting note about the very subject. Thank you, Marc, for joining us today.
Hi, Peter, and thank you for having me.
So let's maybe start straight away. And frankly, as we have a relatively wide audience, Marc, maybe if we could start with a few basics. Can you just maybe let us into the secret? What is private credit in the first place? How large is the universe, specifically here in Europe, but also globally?
Sure, Peter, absolutely. So private credit, in very simple terms, is direct lending from non-bank financial institutions to small and medium-sized privately owned companies. This is what we call the private credit borrowers. Think about it this way. You've got companies like, let's say, BlackRock, Apollo, Blackstone. They create specialized funds, which we call private credit funds or business development companies, BDCs. And essentially, these companies use the funds to lend money directly to privately owned SMEs. Now, private credit involves other strategies like distressed debt or special situations, but really, the bulk of the market is direct lending. So who are these private credit borrowers? They are basically heavily leveraged mid-sized companies with weak or even negative earnings. And here's the key thing. They are typically not big enough to issue high-yield bonds or syndicated loans, and banks will not be particularly appealed by the risk profile. And at the end, the regulatory capital charges that banks have to face to lend money to these SME companies doesn't compensate them. So basically, it's not attractive for bank lending. And also, in terms of the size of the market, right? And why these companies are turning more and more into private credit. So we have to bear in mind that these loans are kind of tailor-made, right? So they are more flexible when it comes to repayment schedules, to covenants, or to the loan structure itself. Plus, the underwriting process is significantly quicker than in traditional lending. So coming back to the second part of your question, Peter, on the size of private credit, I would say it's actually quite substantial, right? Because we are talking about $2 trillion private credit universe. When you look at the geographic split, you see that most of it originates really in the US. So we are talking around 70% of this $2 trillion being originated in the US. Europe and the UK have a more limited footprint. So I would say around 20% of it is Europe and UK, which would represent around $400 billion US dollars. And then the remaining 10% sits in Asia and other geographies. So to give you some context as well, how much is this 2 trillion in the big scheme of things, right, in terms of the credit universe? So this 2 trillion private credit compares with around 5 trillion in leveraged loans, 25 trillion in syndicated loans, and also when looking at liquid public markets, the high-yield universe is 5 trillion, for instance, while the IG corporate debt is around 30 trillion. So all in all, this $2 trillion private credit represents a growing segment and is reaching a decent size overall in the credit universe.
Wow. I mean, these these are big numbers, of course, but as you just elaborated, like in the greater scheme of things, it's still a relatively small fraction of the market. So what are the key concerns then regarding private credit? Why are investors almost suddenly concerned about it?
Yeah, absolutely. That's a very good point, right? I would say the first worry is whether private credit has been growing too fast, too quick. If you think about it, private credit has been under the public radar for many years. The high returns in the asset class kept attracting more and more investors. And at the same time, you had a strong demand from SMEs that were facing potentially difficulties to obtain bank lending. This was the perfect, let's say, match of ingredients for a private credit boom. And private credit markets just exploded in size, growing from around 100 billion in 2010 to around the 2 trillion today that we were just commenting.
Oh, wow.
And now here is where it gets more interesting, Peter, and riskier. Because private credit funds decided they wanted to attract some retail investors too. So not just institutionals, but also retail investors. To make the asset class more appealing, they introduced something called redemption windows. These are periods where investors can actually redeem some of their investments. Typically, this is capped at around 5% by contract. But here is the thing. They were trying to make a deeply illiquid asset class, they were trying to make it liquid. And Peter, that was a very risky move. Now, when we look at these redemption windows, are really putting the asset class under the spotlight. We are seeing a number of private credit funds with redemption requests close to double digits.
That's what we've all read about, right?
Exactly, and that puts private credit funds in a real dilemma, right? Because on one hand, fulfilling the redemptions might force the funds to liquidate some assets and put at risk the investors that want to remain. But on the other hand, halting redemptions makes investors feel trapped and potentially spreading concerns even farther. And as you were referring to, this is what is all over the press all day, right? But I would say there is another concern, probably even more significant in my view, if I may. And this is that many private credit funds have significant exposure to tech and IT industries. And as we all know, AI seems that it's going to disrupt those sectors pretty heavily. And that puts the asset quality of those tech and IT loans potentially at risk. I would say that finally, the structure of the funds is something that is gradually concerning more, not just investors, but also regulators, who are now investigating more in depth non-financial bank institutions and the links with traditional banks. So I would say, to summarize what brought us to this point is really a combination of factors. You got extremely fast growth in private credit over a short period of time. You've got recent concerns around AI and the disruption that this can create to tech and IT industries. You've had some notable defaults as well. First Brand, Tricolor, MFS, we can talk about it in the next questions if you want. And you got structural concerns about the funds themselves. Liquidity windows targeting retail investors, the relatively lack of transparency is as well something interesting to bear in mind, and the significant amount of pay-in-kind loans in these portfolios as well. So, Peter, it's not just about one thing. It's a combination of many things happening together.
I totally understand that, and certainly the redemptions is what has woken up, I think, a lot of people. But I would like to press you on that last point you made, and you just mentioned it, and I certainly picked up on it in the note that you put out. The pay-in-kind loans, for instance, or generally the structural difficulties with these funds. So would you mind elaborating a bit what it actually is, these pay-in-kind loans, and what you mean with the weakness in the structure?
Yeah, absolutely. So now that we've set the scene, absolutely, let's dig deeper into the underlying asset class, because there are some red flags that are worth discussing, right? And I want to be clear. I'm not suggesting that the majority of loans will default, not at all. But we're just pointing out some of the concerns to watch out. As you just mentioned, there are some red flags, right, that there seem to be there. So let's go through them. First, you mentioned this pay-in-kind. Look, around 8 to 10% of private credit loans are pay in kind. And here's how they work. So basically, instead of the borrower paying interest in cash, the interest just keeps piling onto principal. So companies use these pay-in-kind loans for a couple of reasons, really. One is either they are not generating enough cash, which is, to be honest, quite concerning, right? Or the other is that they are growing so fast that they rather use this cash to keep prioritizing growth instead of paying interest on the loan. I would say another red flag is probably the sector concentration, right? And this is something quite shocking to me, Peter, because it's a classic in this type of scenarios, right? 30 to 40% of private credit loans are going to the tech and IT industry. 30 to 40 is enormous, right? Think about that for a moment. Many of these are startups with technologies that could be disrupted by AI in the blink of an eye. Then, this leads me to another topic to follow closely as well, that is asset quality, right? On paper, private credit loans are so far performing well. According to the data that we can obtain, defaults are between 1 to 2%. This is well below the long-term average in high-yield default. That if we look at Moody's default rate, for instance, as you know, Peter, we are at 4.2% for the last average, let's say 20 to 30 years. But we are aware that in several cases, we see a lot of restructuring in private credit instead of default. So again, the lack of transparency is something that can be somehow a bit concerning as well. And another of the red flags, as you mentioned, and we touched upon briefly in the previous questions, are redemptions. This is a topic that has been broadly discussed in press, so I don't want to dig much deeper into that, but it's just to shed some light as well, because the news flow is negative, there is no doubt about it. But to be fair, it is only the retail part that is subject to redemptions. And retail investors represent some 20% of the entire private credit universe. So the vast majority remains institutional investors, and they are not selling, or at least not just yet.
But they are locked in, right?
They are locked in. I mean, there is a chance to sell in secondary markets, but as per we understand, the haircut that they would take is around 10%. So, Peter, if we see institutionals selling, then we have really a big problem. So for now, it's retail trying to redeem some of the funds.
So if I may then, just to move it on, I mean, I totally get where you're coming from. So we've got the redemptions that bring awareness to it. There's some structural concerns in the funds. We certainly have some red flags, as you mentioned, in terms of what is actually in the assets that the funds are holding, the concentration in the tech industry. So I get all that. Let's maybe move it on a little bit. In your note, you're also talking about what you call the three-wave theory of how these small concerns might spawn into bigger concerns. So where's your head at there?
Yeah, that's effectively the key question, Peter. How do we escalate from initial concerns in private credit to a broader concern, right? And again, to explain that in simple terms, we use what you just mentioned, this three-wave theory, right? So first of all, we start with the wake-up call. A set of defaults that started in October-November last year put the investor community on alert. The defaults of First Brands and Tricolor, although they were linked to a fraud to some extent, they were the first signs of stress. Then MFS followed. If you couple these defaults with concerns over software companies disrupted by AI, look, we have the perfect wake-up call. So then we start with the first wave, and the first wave is about redemptions. We are well immersed in this first wave, with redemption reaching these double digits that we were commenting before. In most of the cases, private credit funds decided to limit or not to fulfill these redemption requests. And as we wrote in the note that you were mentioning a few days back, we expected to see the rate of redemption requests to increase. And actually, it happened. There are concerning news, obviously. And while we understand that retail investors represents a relatively small percentage of the asset class as we just discussed, this is a strong reflection of the negative sentiment around the asset class. And then we reached the second wave. The second wave is remarking down the portfolios. And here is when the situation starts to become trickier. As redemptions accelerate, we expect this second wave to impact private credit fairly soon. This wave is going to be focused on remarking down portfolios and on the calculations of the net asset value of these funds. Funds will be under pressure to reprice some of the portfolios, and we expect this to start taking place sooner rather than later. Here is the issue in our view. Too little repricing and market participants might not believe the marks, while too much repricing, in other words, being too conservative, could increase the pressure on the private credit space quite significantly. And then is when we reach the third wave. The third wave is defaults. And if we reach the third wave, and I say if, because if we reach this point, the situation is going to be pretty nasty, then we expect private credit concerns to impact the broader credit universe. The way we understand the third wave is as follows. So, with concerns on private credit valuations spreading, we don't see why other illiquid asset classes, such as, let's say, commercial real estate or infrastructure, will not raise investor concerns as well. At the same time, if this group of SMEs that are borrowing from private credit funds are experiencing financial distress, we struggle to see how private equity, in this case private equity, is not due to a reprice as well. And then banks, but particularly life insurers that are exposed to these markets, as we just mentioned, should also be impacted. So, as we commented before, maybe a systemic crisis might not follow, but a full repricing, in our view, is probably due.
Okay, Marc, now you've got me worried because you just drew the link to the markets that I cover, to the liquid markets, to the public markets, and people who follow my reading or follow this podcast for much longer, they know that, it's definitely like these durations is something that we are watching very closely, and you just brought something to us that potentially could impact the public markets as well. So could you shed a little bit more light? What are the linkages? I mean, you just mentioned banks, insurance companies. What are the links into the public markets, and specifically, this is the European edition of Macro Minutes. How does the situation look in Europe? At the beginning, you mentioned that it's mostly concentrated in the US. So could you maybe weave that in as well? So where do you see the linkages into my world?
Yes, Peter. So links between private credit and banks and insurance companies are definitely a source of concern. But here is the thing. Not all financial institutions are exposed the same way. And geographic differences are absolutely key to understanding this. So the first thing to bear in mind, as you mentioned, is this geographic split. European banks, and particularly European insurers, are much less exposed to private credit than their counterparts in the US. And that all makes sense, right? I mean, we established earlier that around 70% of the private credit is originated in the US, as you just mentioned. So the first takeaway is straightforward and quite reassuring. I can reassure you
That's
that
good to hear.
Here, Peter. European financials should manage volatility in private credit better than in the US. But now let's look at banks specifically. The direct lending from banks to private credit is actually relatively small. In Europe, you've got names like, for instance, let's say BNP, Barclays, and Deutsche Bank, which each of them are around 30 billion exposed to private credit. In the grand scheme of things, that's very manageable, right? We are talking about banks with trillions in total assets. But here is where it becomes concerning to us. If defaults accelerate in private credit, it could impact these banks. And I'm not just focusing on the financial hit that could still be manageable. It's more about the market sentiment. It's more about when investors hold exposures to these names with private credit links, there is always the potential for negative news to be disclosed. But the real issue, if you want, Peter, in my view, are insurers. And let me tell you why. For many years, especially when interest rates were close to zero, insurance companies have been aggressively boosting their holdings of illiquid assets to improve portfolio returns. It made sense at that time, right? I mean, they needed yield. But the question is whether this extra yield can now prove to be much more expensive than they initially thought. In some cases, we are talking about insurance companies holding over 20% of their investment portfolio in illiquid assets and private credit. Well, that's mostly in the US, okay, but in the UK as well. In the United Kingdom, Particularly among annuity-focused life insurers, we have around 20% of exposure to liquid and private credit. That's a relatively large chunk of the portfolio. And just to conclude with that, there is a subgroup of insurance companies that they are even more exposed to that. Some life insurers owned by private equity firms or alternative asset managers. These companies have been more exposed to private credit than the average, and here is the tricky bit. Many of them are domiciled in jurisdictions where the capital rules for holding illiquid assets might be less strict than in the US or in the UK or in Europe, for instance. And this obviously amplifies the risk. So to sum up, I'd say that in Europe, we are better positioned for a private credit volatility event. I believe that life insurers with exposure to private credit and illiquid assets are probably the sector really to watch out.
Okay, thank you, Marc. I'm not quite sure if it's really reassuring, but it's certainly less concerning than it sounded initially. But let me ask you one question that's a little bit out there. I've heard some people talking about that what we've seen so far in private credit is maybe the precursor of something bigger. And I've seen comparisons being made to 2007 when Bear Stearns went down, and whether or not that's sort of the beginning of a new big crisis. That's not really what you're talking about here, is it? So that we're not really on the cusp of a systemic crisis, are we?
Look, Peter, these are actually big words, right? So now let me be clear about where we stand. We are quite cautious on private credit, but we are not in the camp of those expecting a global financial crisis. That said, if we want to explore in a couple of minutes how the contagion mechanism could work if things deteriorate further, I'm happy to do so. So there are kind of four contagion mechanisms that we identified and we published in the note. First, I would say is liquidity and fire sales, right? If private credit funds are forced to sell assets at some point, that's a major concern. But there is another angle. The private credit borrower companies might run out of funds as well. As private credit money shrinks, the weaker names might struggle to extend their existing loans, right? And that could create a kind of credit crunch within the private credit borrower space. Then another contagion mechanism, a classic, leverage, right? And we have leverage. There is a significant amount of leverage within the system. You got leverage at the private company borrower. You get leverage at private credit funds that in many cases they use some degree of leverage, and you have leverage at the end of the chain as well with investors such as hedge funds or insurance companies that are intrinsically leveraged by the type of business they are conducting. So leverage is there, and we have several layers of leverage, one on top of another. Third mechanism is defaults. And here is the thing. It's not just about the private credit borrower that defaults. Think about the ripple effects. What happens to their suppliers? What's going to happen to other companies linked to them? A default doesn't exist in isolation normally. And the fourth contagion mechanism is the high degree of interconnectivity. Banks, insurance companies, private equity firms, pension funds, there is a large ecosystem that developed around private credit, and almost without noticing, it kept growing and expanding. Everything is connected, and regulators and supervisors are starting to look now more in depth into that. Look, Peter, I understand some people might disagree with our views, but let me tell you something. Something I see on a daily basis as a bank's analyst. Finance is built on trust. And when you lose trust, the chances of reverting that situation are low. I understand the arguments from some market participants with a more constructive view on private credit. They point to the low default rate in private credit. And on paper, the space looks like it's holding up well. That's fair. But here's what I recall. Credit Suisse looks solvent on paper too. But it lost investors' trust. And with that, it lost everything. There is a saying that is well known in banking, and it goes like this. Worse loans are made at best times. We've seen a blossom in private credit over many years, supported by a resilient economy. A financial crisis might not be necessarily following, but there is definitely some cleanup to do. And for some market participants, that cleanup is going to be painful.
Super, Marc. That's super fascinating. It's super interesting. It's maybe not what some people want to hear, but maybe it's what some people have to hear. So we definitely come back to that topic. I'm pretty sure about it. So for now, I think we have to wrap it up. Thank you, Marc, for being with us and sharing your insights and your expertise. Thank you for everyone who has been listening, and I hope you're going to tune in again when we speak about either the European situation or the global edition next week. Thank you.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.